This is the Market Cycle Mastery class. Investing is more than just numbers. Market cycles are more than mere patterns. But what is it about market cycle investing that makes a difference in wealth generation? You'll learn about the importance of recognizing trends, how timing is crucial in investments, and how the right strategy can make all the difference in your financial growth. In this class, we will dive into 3 topics. First, you will learn that many investors believe that what drives the market is the economic cycle, but it's not. The emotions drives the market. Understanding this is what gives an edge to the investor. 2, you will understand how to maximize your returns with one investment strategy for all different market phases. And the 3rd lesson will teach you how to build a dynamic portfolio here in Wall Street. I'm Dan Castro, founder of Zurich Capital and author of the Wall Street Insider Report. Before we start, let me tell you that this class is not a one-way road. It's a conversation between you and me. Feel free to send your questions in the comment section. The psychology of market cycle is a fascinating concept that delves into the emotional roller coaster investors ride through the different phases of a market cycle. It's a dance of hope, fear, and greed, choreographed by the rhythm of the market. This dance is not just about numbers and charts. It's about human emotions and behaviors that can often lead to irrational decisions. Understanding the psychology of market cycles can provide investors a significant edge. It can help them anticipate market movements, make better investment decisions, and ultimately achieve better returns. So let's delve into this intriguing world of market cycles and the psychology that drives them. This graph represents perfectly the roller coaster of emotions in the market. Hope. Fundamentally strong companies with attractive growth prospects and increasing institutional interest. Optimism. Prices stabilize after a significant decline, indicating a potential bottoming process. Belief. Strong uptrend. This phase is characterized by a period of increasing buying pressure in the market. Euphoria. The general public, including retail investors, starts showing significant interest and participation in the market, contributing to its rapid price appreciation. Anxiety. The uptrend starts losing momentum, indicating a potential market topping. Denial. The market undergoes a significant reversal from the previous uptrend, indicating a transition into a bearish environment, and the cycle starts again. And so the emotions market cycle chart is a graphical representation of the phases a market goes through over time. It's a reflection of the collective emotions of investors, from optimism and euphoria to anxiety and denial. We could see this pattern repeating over and over. By recognizing and analyzing the 6 distinct phases of price cycles, this strategy aims to help investors navigate the market more effectively. Let's delve into each phase and explore the corresponding investment approaches. Institutional Phase 1. Transition from a downtrend to an uptrend as smart money accumulates positions. Transition from selling to buying pressure. Investors should detect early price shifts, focus on fundamentally strong stocks, and await confirmation of an uptrend. Basis Phase 2 or accumulation phase. Prices stabilize after a decline. Phase 2 is marked by price consolidation, decline in selling pressure, indicating a downtrend nearing its end. Wall Street Insiders. Phase 3. It's the best reward risk point for buying. The market exhibits a consistent rise. Strong and steady uptrend is observed. Market shows higher highs and higher lows, and technical indicators confirm the trend. Investors should buy and hold to maximize returns. The public Phase 4. Period of immense public participation and heightened enthusiasm, extensive media and influencers' attention. It has a significant retail investor involvement, often driven by fear of missing out, predominance of speculative behavior. It's the peak of optimism and euphoria in the market, possibly unsustainable, price appreciation, where large institutions may start exiting, securing profits. The top Phase 5, or distribution phase. The uptrend begins to falter, hinting at a market peak. Uptrend starts to weaken, and price movements are consolidated within a narrower range. Visible signs of distribution, such as institutional selling. The uptrend starts losing momentum, indicating a potential market top. The decline Phase 6. The market shows a drastic shift from the prior uptrend, entering a bearish phase. It's the time to sell. persistent decline in stock prices with lower highs and lows, escalating selling pressure dominates. Technical signs like breakdowns below key support levels emerge, and investors should emphasize risk management, prioritize capital preservation, and consider defensive strategies. Understanding the phases helps the investors to invest smartly by identifying the exact points of buying and selling to maximize returns and protect their capital. It's a step ahead of the buy and hold strategy. The investors hold the assets only during positive cycle or phases 3, 4, and 5. We strategically combine leveraged assets with protective assets, adjusting them according to market cycles. This approach has enabled us to consistently outperform the S&P 500 index over a decade. Our Alfa Hedge strategy algorithm observes 3 pieces of information and defines the portfolio optimization accordingly. Alpha 1 Market Cycle Phase. With this analysis, we define at what time of the cycle the asset is now. We analyze the present situation of the asset. Alpha 2 Highest historical positive volatility or highest probability of long-term uptrends. With this information, we analyze the past of the asset. And Alpha 3 Highest expectancy ratio. With this data, we analyze what to expect in the future based on statistics. The optimized position size was created by computer scientist John Kelly in a 1956 paper referenced in William Poundstone's book Fortune's Formula, and later popularized by Edward Thorpe when he applied the theory to beat the game of blackjack. It was also applied by Jim Simmons, founder of the hedge funds Medallion and Renaissance. Dynamic capital diversification allows the investor to take advantage of positive market cycles with controlled risk. This form of diversification allows for greater predictability of results and consistent returns over the years with reduced risks. Traditional portfolios offer constant allocation to a universe of assets. However, the returns from these investments can be variable under different market conditions. The winners carry the losers. Dynamic diversification allows for more stable returns, as the allocation of assets is determined by the market cycle and its historical volatility. You don't go to the beach when it's cold and raining, do you? By following the Alfa Hedge portfolio, you will end up knowing when it is riskier, and it is essential to keep a close eye on all the assets you already own. Step 1. Establish the universe of assets of the Alfa Hedge portfolio. An important point in managing the Alfa Hedge portfolio is to find the sweet spot of diversification. Within our algorithm, we currently filter the assets within bonds, currency, stocks, and crypto through ETFs. Step 2. Analyze the cycle of each market. But the main difference of the Alfa Hedge portfolio from the assembly of traditional portfolios is that in it, you don't need to be with all asset classes at the same time in the portfolio. You eliminate the losers and keep the winners. Step 3. Portfolio rebalancing. We keep our positions for months or years, so on the first Monday of each month, we check the phase of each one of the markets in our watch list and assemble, or not accordingly, our risk management position sizing algorithm. At this point, you know that what drives the market are emotions more than any other thing. You also know that every asset passes through 6 phases, and identifying the right time to buy and sell is the key to a successful performance. You learned that a dynamic portfolio is the most effective way to navigate the market cycles. Most of my clients are passionate about investments, business, and technology, but they face a dilemma. Seek balance between personal and professional life, aiming to grow their businesses and their careers, and maximize their investment returns, yet feeling the pressures of time constraints, decision-making insecurity, and the challenges of the investment world. That's where we come in. Our job is to make you gain time in your investment decisions. And if you want to go ahead, I invite you to become a premium subscriber of the Wall Street Insider Report. Click on subscribe and join our community of global investors who are anticipating the market, demystifying the market cycle, and investing smarter in Wall Street. Thank you for watching.